Are you low-key asking yourself if you're about to get caught in a financial trap you didn't even see coming? For most young people, building wealth feels like climbing a slippery slope, and every dollar you manage to save is precious, hard-won capital. So, the question that keeps many of us up at night isn't just, will the market go up? But, am I risking years of my life savings on pure hype? Think back to the late 1990s. The world was gripped by a financial gold rush, the internet, where companies with no profit were getting billion-dollar valuations just for having a .com in their name. Everyone who jumped in felt like a genius, for real, until the year 2000 hit, and nearly 80% of the NASDAQ just went poof, leaving millions of hardworking families shell-shocked. It was a brutal lesson in overconfidence. Now fast forward to today. That same electric energy, that same sense of unshakable euphoria and belief that this time is different, is back again. But it's not driven by the internet. It's fueled by artificial intelligence. It feels exhilarating, yet simultaneously terrifying, because the stakes are infinitely higher for those of us struggling to save. If you lose money now, it's not just an investment setback. It could cost you, fam, and delay your financial goals for years. That's why, when I say, it's happening again and nobody's talking about it, I'm not just talking about stock prices. I'm talking about a structural issue, period. We're facing three hidden forces that weren't around in 2000, that suggest this potential bubble is not just bigger, but potentially way more damaging to the average person's financial future. The first hidden force that makes this era so mesmerizing and so potentially dangerous is the sheer unprecedented concentration of power, the Magnificent Seven. These seven colossal companies, Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia, aren't just big. They collectively make up over a third of the value of the entire S&P 500 index, meaning if you hold even the most basic index fund, you're already big-time invested in their success. And what are they doing? They are locked in an AI arms race, pouring unimaginable wealth into dominating this new technology. We're talking about $330 billion in planned AI spending from this group in just 1 year, a figure that dwarfs the entire annual economic output of many developed nations. Global spending is expected to top $500 billion by 2026. This spending is exciting, painting a picture of a fourth industrial revolution, and it promises fantastic investor returns. But here is the critical rehook, the factor that hits the middle class hardest. This massive expenditure appears to be the primary engine currently keeping the broader economy from entering a mild recession. That's a scary thought, man. Your portfolio's stability is essentially balanced on the continued, frantic spending of just 7 entities. Furthermore, the excitement over AI's potential for profit is directly linked to the biggest insecurity facing every working person right now: job displacement. The IMF estimates that around 60% of jobs in the developed world are exposed to AI, meaning the same technological advancements that are fueling your stock market gains are simultaneously putting your job security, the income you need to fund those investments, at risk. The tension is real. You gotta invest to keep up. But the companies driving those gains are developing the very tools that could make your career obsolete. That's a financial paradox you need to understand, straight up. This is where the story shifts from simple euphoria to structural risk, and it's the second and third hidden forces that explain why a strong degree of caution is warranted in today's market. Behind the soaring stock charts lies something being referred to as the AI money machine, a closed-loop flow of capital that can artificially inflate revenue metrics. Picture this: major tech players like Microsoft, Oracle, and Nvidia are constantly funding, investing in, and buying from one another in a cycle. Nvidia sells chips to Oracle. Oracle buys data centers from Microsoft. Microsoft invests tens of billions into OpenAI. OpenAI pays Microsoft back to use their infrastructure, And then Nvidia, the biggest winner, invests back into OpenAI to ensure they keep buying its chips. It's like friends taking turns paying each other $1,000 to dig a hole and then fill it back up. And suddenly everyone is reporting $1,000 in revenue and being valued like a highly profitable company. That is some questionable stuff. No cap. This circular spending is boosting stock prices, but the crucial missing piece is real, sustainable profit from outside the loop. Companies like OpenAI are valued in the hundreds of billions while losing money hand over fist every month because their AI services haven't yet proven they can generate enough organic revenue to justify the hype. That fragility leads us to the final, most important hidden force: the data wall. AI's rapid progress has been built on devouring centuries of human-generated data, every book, article, and research paper ever published online. Experts predict that by 2027, AI will have consumed nearly all available human-created content. If the market is betting on accelerated, continuous progress, what happens when the fuel runs out right around 2026? Think about that. If progress stalls because AI hits this data limit, the high valuations based on future expectations could collapse. Unlike the dot-com bubble, which was a clear overvaluation of a growing industry, this potential volatility is being driven by structural financial loops and a literal scaling limit. If the core engine of AI breaks, there may not be a simple reset, but a deeper structural crisis in the tech sector that threatens every middle-class investment and job tied to its promise, for real. So, is this a bubble? Based on the overvaluation, the unclear revenue signals in the money machine, the geopolitical mania, and the looming scaling limits of the data wall, the signs are all there for increased volatility. However, knowing that a potential crisis is brewing isn't a reason to panic. It's a reason to prepare, especially since market bottoms are where fortunes are truly made. I'm not a financial advisor, but the key to surviving and thriving in this environment is discipline and a clear focus on the factors you can control. Firstly, continue to invest regularly and automatically. If we are in the early or middle stages of a potential bubble, the prices we see now might actually look like bargains in a few years, even if we hit turbulence first. The secret is committing to a broad, low-cost index fund every single month, no matter what the headlines say. Why? Because historically, the market always recovers, and by consistently investing through a downturn, which is what I did during the dot-com crash, you lower your average cost and maximize your future returns. To do this without stress, you must ensure you are not over-leveraged or financially vulnerable. The investors who lost everything in 2000 were the ones forced to sell at the bottom because their finances were mad stretched. Secondly, treat your income as your most powerful asset. Your job, your side hustle, your raises. That's the fuel for your wealth engine. Focus on increasing your earning power first, because more income allows you to buy more assets when prices are falling, supercharging your wealth accumulation, just when everyone else is running scared. Finally, prioritize mandatory diversification. Putting all your eggs in the tech basket is a recipe for disaster in this AI-driven, highly concentrated market. Spread your money across different asset classes, not just stocks, but also potentially bonds, real estate, precious metals, and even a small, educated position in crypto. This diversification acts as a shield, ensuring that if the AI bubble bursts, the rest of your wealth remains relatively intact, allowing you to seize the opportunities while everyone else is running for the exit. Understanding this structural uncertainty means you won't be a victim of the panic. You'll be the one taking advantage. Hit the subscribe button and the bell so you don't miss that next deep dive. Thank you for watching. Peace.